class. Tonight's class is going to be on choosing the right option. So, how do I choose the right option? How do I choose the right strategy? How do I choose the right strike price, the right expiration date? And that stuff we're going to go over today. We have calls, puts, vertical call spreads, put spreads, and then we have our butterflies that we trade, okay? Now, when do we use each? Okay. Now, let's go over that example here. First off, I want to start off with Tesla. Okay. We went over Tesla today. Tesla closed at around 422 per share today. It just had great earnings. They announced incredible revenue, EPS beat, and the stock's climbing. It's up 15 bucks. Okay. So as you guys could see, the stock's at 437 now. Okay. Now, the first thing I like to do, I want to go over butterflies first. Okay. Because this is really important. I like trading butterflies when we're looking for something that's a little bit higher risk that we're not sure if it's really going to work out for us or not. Because let's be honest, Tesla earnings trade, you're not sure if that thing's going to go up, if it's going to go down, or where it's going to go to. But the one thing that we can look at is the implied move, okay? And if we looked at the implied move on Tesla, the implied move for this week was 8.34%. from now until October 23rd. All right. We already have the stock up over 3.5% here. So another couple of percent, and we'll be at that implied move that Wall Street was expecting. So when Tesla was at 425 this morning, 425, multiply that by 0.0834, that's a move up or down of about 35 points. So that would have easily gotten us up to about 450 to 460 a share. Okay, with that implied move. So now with that being said, if it got us up to 440 to 450, right, we could do a couple of things. And with the butterfly, how butterflies work, let me go over this with you. So let's say instead of doing a call, which is really expensive for this week's expo, remember, look at this stock here. It closed at 422, right? 423. So if we take a look at where the stock closed at and we got the 425 strike, that means for one single contract, you're paying $1,625 for this trade. Okay. So your break even is going to be your strike price plus the premium paid. So in this example, say 425 strike plus 16.25, that means your break even is 441.25. Now to make 100% gain, you need to add another 1625 higher. So add another 1625 to that, and you need Tesla at 457.50 a share to make a 100% gain. Now, first off, look at how much money you're risking for a single contract. You're risking $1,625 for one contract. Now, for a lot of you that got mid to small size accounts, that's going to be a big majority of your account there. And that's simply out of the question in terms of risk and trade management and portfolio management there. So it's really important to understand those strategies and which one's really the best one for you. So it's either A, you could have risked $1,625 by buying that regular call and saying, okay, if she gets up to that 450 or 460, well, at 450, I'm going to lose money. At 460, I'm going to start making some money. At 450, 750, I make 100% return, right? So now it's either I can make 100% return with buying that call and the stock getting up to 450, 750, or I could do something like a spread. So if you got that 445, 450 vertical spread there, that was going to cost you about $1.48 to be worth $5. 5, divide that by 1.48. That's a 237% return. So you have a 237% return with the stock at 450. Compared to if you got the regular call and that got up to, what do we say here? So at 457.50, you have a 100% return with the call. Okay, now watch this with the butterfly. So With this, you're risking $1.48 or $148 for a single contract to be worth $5 or $500. So that $148 would be worth $500 if you got this vertical spread, as long as Tesla's at or above 450 a share by October 23rd Expo. Now, here with the butterfly here, I like using butterflies for something that's a little bit more risky like this because it gives you a little bit better risk to reward ratio. So now let's say we were expecting Tesla to get to that 450, right? So now if we did the 445, 450 vertical spread on Tesla here, take a look what this was going for at the end of the day. So one single contract. First off, let me explain to you guys how a butterfly works. It's called a butterfly because you have two wings and a body. So the outer strikes here are going to be considered your wings. And the inner body here is considered, the inner strike here is considered your body. So your wing is 445, your second wing is 455. The body of that butterfly, known as a call fly here in this example, or a put fly if it was puts, this is considered a call fly. So the inner body is where you make the max gains at. Anything above that, your gains start to diminish until they become worthless. Anything above 455, totally worthless. Anything below 445, totally worthless. Your break even is going to be that strike price of that first and of that first leg here. So 445 plus 38 cents. So 445.38. So that wing, I don't want to call it a wing, so I'm going to just call it the first leg here because that's what these are, legs. So that first leg there is going to be the strike price plus 38 cents for your break even. So for this call fly on Tesla, you need the stock at 445.38 to break even. Now, if this stock pins and gets up to 450 on October 23rd, well, guess what you just made? You made the difference between that first strike and the body here and the inner strike. So the difference between those is $5. So if you paid 38 cents, 5 divide that by 0.38, that's a 1,216% gain with the stock at 450. But the thing with the butterfly is you really have to pick those strikes properly. And if you pick those strikes too tight here, let's say you did the 442.50, 445, and 447.50. You see here, it's going for 65 cents to be worth 250. Not something that really bites my appetite, right? So on this example here, you see that with this call fly, we can make $5. That's the max it can make. Anywhere between, well, for that max gain, we need that stock at 450. Okay. So that's what I want you to focus in on. It's really important for butterflies to be looking at these implied moves, especially with calls, vertical spreads, puts, anything that we're trading. Always be looking at that implied move because Wall Street knows what that implied move is going to be, and they post it there for us. So when you're trading earnings, I really like to go with those butterflies, okay? Or we could also do our special condors. So what we do is we do a total ticket trade. So this is actually the fifth type of option that we would trade. This is one of our special iron condors. So if we did Tesla here, right, and we add 4 legs, okay, buy to open, sell to open, buy to open, sell to open, one of these are going to be a call spread, right? And then one of these are going to be a call spread. Okay. So now all we're doing here is we're saying this is going to be a put. This is going to be a put. Now, remember that implied move on Tesla, right? So that implied move on Tesla was 8.34%. The stock closed at around 423. 423, multiply that by 1.0834. That brings us up to 458.27. So 458, that's the upper end of what Wall Street's expecting Tesla to get to by the end of this week. So if they're saying, hey, Tesla might get up to about 458 by the end of this week with that implied move, that's going to be the upper end of your vertical spread on the call side. Okay, so I want to go a little bit in the money there. So what I might do here is say, okay, let's do maybe the 447.50. Yeah, we could do the 447.50, 450. That sounds good to me. Now, obviously, on this call side, there's a $2.50 difference, right? From 447.50 to 450. Now, on the put side here, remember, they're expecting a move up or down of 8.34%. So again, if we now do 423, multiply that by 0.0834, that's a move up or down of 35.27. So if the stock was at 423 minus 35.27, that would bring us down to 387.73 on the low end if it missed earnings and had a big drop. So now what we do is we could be looking at the let's see, the 390, 387.50. Let's see here. So we could be looking at the 390, 387.50. Okay, now what you're seeing is you got a trade that's between 70 cents and $1.70. Okay, so that's going to be about 0.7 plus 0.5. So that's going to be about $1.20. Okay, so the midpoint on this is about $1.20 contract. So that's your midpoint is $1.20. So if we went here and did net debit, we'd be looking to pay $1.20 contract for this. Now, here's the nice thing about one of our special iron condors. Okay, it doesn't matter if the stock climbs or drops. We're going to make money either on that call spread or that vertical put spread. Remember, the max this spread could be worth is $2.50. So the call spread on this special condor could be worth $2.50. The put spread could be worth $2.50. If we're only paying $1.20 per contract for both, all four strikes here, all four legs, well, guess what? That comes out to what? 30 cents per strike, right? So if one of these made $2.50, that's going to cover the cost of all of these contracts here and leave us with a gain, as long as that stock has that implied move of that 8.34%, actually a little less, probably about 7.5%, because I like doing those strikes within the implied move, not higher than the implied move, but within the implied move on the outer limits there. So when you're looking at a earnings trade, this is something else you could do if you're not sure where that stock's going to be going to. If you say, hey, I think Tesla is going to have a big move up or down, I don't know what it's going to do, but it's going to be a big move because of either A, COVID sales were really bad, or B, Elon Musk is a great salesman. He lowered the price of his vehicles and he's selling a ton of them. You know, it doesn't matter. If you're bullish or if you're bearish, as long as that stock has a move within that implied move from now until that expiration date, you're going to make that profit. And as you can see, Tesla shares are still climbing. So Tesla closed today at 423 a share, right? It's at 438 right now. So both of these strikes here are still worthless. But guess what? It's only about an hour since they reported their earnings. So tomorrow, let's say Tesla gets up to 450 a share, right? Let's say it gets up to right at resistance here of around 461. If it gets up to 461, that means this part of that condor is going to be worth max gain. The 447.50, 450 vertical spread is going to be worth $2.50. Well, guess what? If this is going to be worth $2.50 with Tesla at 261 a share, so this call spread is going to be worth max value. So we're going to get $2.50 a contract. If we're only paying a midpoint of $1.20 for all of this, the call spread and the put spread, well, guess what? that's going to make us a 100% return. Actually, it's making us more. 2.5, divide that by 1.2, that's a 108% return. 108.33% return. And the nice thing about this trade now, let's say Tesla dropped all the way down to, that support area at 375. If it dropped down to 375 after that earnings, well, guess what? Then as long as this stock's below 387.50 on Expo, then this would equal $2.50. Okay. And then this one would be worthless. So with one of these special condors, one of these contracts, one of these spreads are going to be worthless, and one of them is going to be worth max value if it has that implied move and climbs above both strikes, either on the call side or below both strikes on the put side. So these special condors are really great to trade here for earnings. That's why when earnings come up, I like to either trade butterflies, or I love to do these special iron condors right here. And all you have to do is go to total ticket trade and you put those in. So it's really important there to decide what strategy is going to be best for you. Okay. Now let's look at a trade that has non-earnings here, because not all trades have earnings. And like I said, I wanted to find some things here that really give us good examples so you guys could see without, cherry picking anything. Okay, so let's keep this on a 6-month daily chart here. And now let's take a look at something like that. So let's say that there are hopes of a stimulus deal happening next week, right? Well, what's going to happen? Well, if we have a stimulus deal next week, let's take a look at what these calls are going for. Something we could be proactive about. All right, so if you take a look at that 13 strike call now, that 13 strike call is going for, last traded at 58 cents. Our break even would be 13 plus 0.58 equals 13.58. And that equals our break even. Okay, so 13.58 is our break even, 13.58 plus 0.58. So that means at 14.16, we have a 100% return, right? So 14.16, if we pick this up, we'd have a 100% return. That's not too bad, right? Now, so let's write that down. So at 14.16, we have a 100% return with the calls. And the calls are only 0.58 cents. So that's pretty cheap, right? So now there's one strategy that we could be thinking about here for an American Airlines trade if we get that stimulus deal passed. We still think that's going to get up to 15, but now if we make that 100% gain at 14.16, let's see what a slight out of the money vertical spread does for next week's Expo. So let's say the 13.50 14 vertical spread. Well, now guess what? Our max gain on this is going to be above $14 a share. It'd be worth a max of the difference between the two strikes. So this could be worth a max of 50 cents. Remember that call we were talking about? If we picked up that 13 strike call, that's going for 58 cents. You guys remember, to make a 100% return on that call, we need the stock at $14.16 a share to make a 100% return. Now, this trade here, we need the stock lower than that 14.16 a share. And guess what? This trade only costs 13 cents to be worth 50 cents. So 0.5, divide that by 0.13. That means this trade here is going to make us a 285% gain, and it only costs 13 cents a contract, or $13 to be worth $50 per contract. So now you're kind of seeing how important it is to not just look at those charts and say, hey, let me just jump into some calls, because there's so many traders that'll join us. And when I get an out of the money vertical spread, they might get an in the money call or something, and then they lose money on it while my trade's making money. So now you see how with going with this out of the money vertical spread, you could turn $13 into $50 or have a 285% return. And like I said, if you bought that 13 strike call, well, guess what? If it got up to that 14, 16, that's where you make 100% return. So with this one, you need the stock even lower, 16 cents lower or higher, and you're making a much larger gain. Now, let's take a look and see what happens if we get an out of the money. So now let's take a look at if we did a butterfly. Now, a butterfly here, I'm thinking it's going to be a little off between the bid and the ask here, but let's just say we did the 14, 15, 15 vertical spread. Now you see what's going on. Okay, now you're able to pick this up. Now I understand this is higher risk. You need the stock between 14.50 and $15 to make that gain. But guess what? This contract here is going to cost you 3 cents. And guess what? If that coronavirus bill gets passed and you get a big candle like this, you're going to easily quadruple your money, or this is going to be worth at least 10 times more than what you paid for it if we get that big candle on any type of bill that's get passed. Okay, so now you're paying 3 cents for it to be worth a max of 50 cents. Okay, 0.5, divide that by 0.03. That's a max net gain of 1,567% if American Airlines gets to $15 a share on October 30th. Okay, you'll start making money anywhere between $14.53 and up to, about $15.10 a share. So that first that's what the nice thing about this. That first candle you get that has that big breakout, you're going to be able to easily sell this for triple, quadruple of what you paid for it. So that's the nice thing about getting that butterfly, that spread, or that call that takes you up to that resistance area of $15. Like I said, if we didn't have any type of coronavirus bill going on, I wouldn't be looking at that target so far out of the money. But since we've seen what it does in the past year with that coronavirus bill, when we went from $8 a share all the way up to $22.50, well, that's a big difference there. And that's really important to be watching that and keeping your eye on that. So you see how there's different types of strategies, depending on what's going on. Now we could start talking about stops and targets. Okay, we went over strategies and finding the different types of strikes, the different types of expo dates on those types of trades. Now let's talk about if we were going to get regular calls on Apple here, right? Apple just had their earnings event. First, you always want to look before you make any type of trade, see what's going on with the earnings calendar, see if there's anything going on. AAPL, if you guys look, it's got earnings next week. So you already know, that these options are going to be pretty cheap for next week out or longer. So that's going to be one that I'd stay away from. But if you wanted to take a look at it and you say, okay, I want to make an earnings trade on it, well, Apple's at 117 a share now. So if you picked up that stock, 117 plus 383, that means your break even is at 120.83. And then for you to make 100% return, add another $3.83 to that. And at 124.66, you have a 100% return. Okay. Now let's take a look at what the implied move is for Apple for next week. Well, as you can see here, Apple has an implied move from now until next week's expo, and it tells you right here the next earnings date is on October 29th after the close. So from now until they report earnings until October 30th, they're expecting a 6.75% move up or down. So if we take, let's just round it up to 117. So 117, multiply that by 1.0675. That would bring us up to about 125 target. And if it had that drop lower, 117, multiply that by 0.0675. That would be about a $7.90 lower from where it's at right now. So 117 minus 7.9, that would bring us down to about 109. We'll say 110. Okay, so now with that being said, you know if Apple has that implied move higher, it's going to get up to about 125. If it has that implied move lower and it misses earnings, well, then it's probably going to be dropping down to about 110 a share. 125, look at that. That's right at resistance. That's a beautiful sweet spot to have our target at. So now if you picked up that 117 strike call and it got to 125, well, 125 minus 117, that means this contract would be worth $8. If you paid $3.83, 8 divide that by 3.83, that's a max net gain of 109%. So you made 109% if it got up to that 125 target with a regular call, picking up that 117 call. So you got to ask yourself now, all right, well, I got about a week and a half until expiration. It has earnings coming up. Do I think it's going to get to 125 or higher from now until next Friday? Well, if it gets up to 125 and I just buy that 117 strike call, I'm going to make about 109% gain. Now let's take a look at that spread and do something within that implied move for that spread. So if we pick up the October 30th, let's say we pick up the 123, 120. Well, we'll do the 124, 125, just like that call. Perfect example of comparing apples to apples. So now, if you got up to 125 with those calls, you made 109%. Now, with these vertical spreads here, this call spread, if you think it's going to go higher and get up to that 125 target, right? That's your target. Well, now the max this could be worth is $1. Guess what? If you paid 20 cents for that, $1 divide that by 0.2, that's a 400% gain doing that out of the money vertical spread that's within that implied move. So you see how with earnings, you really got to focus on that implied move and where it's going to be targeting and where it's going to be dropping down to. Now, this is on the call side. Let's say you think, hey, I don't think Apple's going to have a great earnings. I think instead they're going to be dropping lower here, and you wanted to get into a put spread instead. Well, remember, our put spread with that 6.5% move lower, 6.75% implied move from now until October 30th, that would bring shares down to 110. Okay, so now instead of doing a call, let's say you wanted to do a put spread, right? And let's say you wanted to do the 111, 110, which is within that implied move. Remember, the implied move brought us down to 109. So it's still within that implied move. Now the max net gain on this put spread is going to be the difference between the two strikes, which is $1. And if you're paying 26 cents for it, divide that by 0.26, that's a max net gain of 285%. That's not bad for a spread that's within the implied move that Wall Street's expecting. All right. Now let's do it one step further here and go with that call fly again and say, okay, let's say we wanted to do that call fly and we really think Apple's going to pin at that 125 by next week, you know? So now we do let's say we do the 124, 125. That's a tight butterfly there, but it's not giving me too much more. Now, see, this is the beauty of this. Take a look. The max this could be worth is $1. The difference between 124 and 125 is $1. So at 125 at expiration date on October 30th, this would be worth $1. If you're paying 8 cents for it right now, 8 cents for it to be worth $1, divide that by 0.08, that's a max net return of 1,150%. Now, here's the nice thing about call flies, team. Okay, let's say Apple has a great earnings and it pops up to 120 to 125 really quick. You're not going to wait and sell this on Expo Day. You want to just quickly take that 500% gain or whatever you have on that big climb after earnings, lock that sucker in. If that's worth a quick 50 cents and you paid 8 cents for it, 0.5, divide that by 0.08, that's a 525% gain, even if you sell it for 50 cents instead of that $1. still making a 525% gain. So it's important when you have that move higher with the out of the money butterfly like that, out of the money call fly like that, you know, as soon as you get that first big green candle, higher, that's going to significantly increase that midpoint there from maybe 8 cents to 30 cents or 8 cents to 50 cents. So it's really important to quickly lock in that profit. So you got to see and understand when you're looking at these different types of strategies. Number one, if you're doing a low risk trade, find a vertical spread that's below support. That's going to help save you. It's not going to give you those major returns like we're used to seeing, those 200-300%ers, but a decent 50% gain on a trade like that could drop and you still not lose much money. That's a good risk to reward ratio set up right there. You look at the chart here, your stop is going to be even a little bit higher. I'd have my stop at 170, 173 or 170, 175. And the beautiful thing about that, if it comes down to 172, guess what? It's still above max gain here. So you could sell your trade then if it broke below that support, and you might be able to sell it for $1.30. So you have a 28 cents loss or $28 loss per contract. That's not bad. You're minimizing your risk by going with those in the money vertical spreads. So everyone is always trying, hey, I want that 300% gain. They're going with the out of the money vertical spreads there. And, sometimes they pay off, sometimes they don't. And when they don't pay off, you're usually having a total loss there. Now, if you utilize this type of strategy, getting the in the money vertical spreads that are below the support area, that's going to drastically help you there. It's going to minimize your losses and maximize your gains. And the stock could drop, stay where it's at, or climb, and you're still going to have that gain. So that's what you got to be doing when you're looking for expiration dates, is make sure you're look at the calendar. Is there any dividends coming up? Is there any type of earnings coming up? If there's dividends coming up, you don't want to sell options because then you're going to owe the dividend to that other person. So if you have those options there and you're short options, you have to pay that dividend to that person. And if you have 100, let's say you got 10 contracts, and there's a 50-cent dividend, per share. Well, if you have 10 contracts, that's control over 1,000 shares. 1,000 shares that pays a 50-cent dividend, you're going to owe $500 dividend to that call seller that you sold those options to. Stay away from dividends. Stay away from expo days if you want those safer trades. If you want those higher risk earnings trades, well, now you know the strategies that you could utilize for them. Now, let's find those target profit areas. Okay. So tonight's class, I really hope this helps show you that during these times of instability, you got to find the right strategies. You got to find the right strikes, and you got to find the right expiration dates. We went over out of the money strikes. We went over in the money strikes. We went over pre-earning trades. We went over earnings trades, and you saw the implied move, the difference. And most of all, you saw the best types of strategies to trade for earnings season when you have high risk trades that are being made, because you obviously don't want to pick up regular calls or puts for earnings. They are very expensive and very high risk. When you could utilize different strategies like spreads, butterflies, or special iron condors, they're going to greatly reduce risk, reduce the cost, and give you much larger risk to reward ratios there. Now, that was tonight's class there. Now, what I wanted to show you guys too, number one, is there's something else I wanted to go over here. We went over the strategies there. We went over the strikes, the expiration dates. Now, what I wanted to really go over with you guys here is let's find a stock that's in breakout momentum. All right, here's a good one. McDonald's, right? It's still in breakout momentum, right? This is one that you see. First off, we look at our calendar, right? We go to our calendar. We look at MCD. Is there any earnings coming up? Nope, no earnings coming up this month. How about next month? Earnings coming up on the 9th, okay? Now, you just remember Chipotle had record-breaking quarter this quarter with delivery sales in Uber Eats, right? I expect the same with McDonald's. Everyone's going with McDonald's, right? So I'd be looking at the November 20th Expo on McDonald's. McDonald's just had a bunch of upgrades. So you're always also looking at those upgrades, downgrades, unusual options activity. And if you take a look here, let me show you this, which is really important. So you see here, McDonald's, MCD, JP Morgan maintains overweight. Overweight's a very high rating. They raise their price target to 220. Morgan Stanley maintains overweight on McDonald's. Raises price target to 248. Truist Securities maintains buy on McDonald's. Raises price target to 246. BTIG maintains buy. Raises price target to 245. BMO Capital maintains outperform, which is the highest, you could do. Increases price target to 235. Jefferies maintains buy on McDonald's. Raises price target to 260. There's no downgrades on McDonald's, right? Therefore, what do you see? You see McDonald's continuing that breakout momentum cycle, right? And you see how important that is, because this is showing you going back a few days. This is going back all the way back to October 9th here. And if we keep going down here, you'll be able to see more upgrades. But October 9th, it's now October 21st here, and we're still in breakout momentum here. So even going back to October 9th here, which was right here, we've been climbing since we got those upgrades, right? So now we see that McDonald's earnings is on, what did we say? McDonald's earnings is going to be on November 9th. So if we got the November 20th expo, we should be fine. And look at those price targets. It's important to look at those. 220, 248, 246, 245, 235, 265. So the average is going to be right around 245, 250, right? So guess what? If we're looking at a McDonald's trade, we can make a safe trade if we want. We could make a trade that expires November 20th. Now, if we pick up the, let's say the 230 strike call, we need this at 243 to make 100% return. Well, hell, that's pretty far out of the money, isn't it? So on something like that, the option premiums are too expensive. So what I'd rather do is do a vertical spread, buy to open, sell to open. So this is how we're looking at different strategies. We just looked. Now, if we were bearish on that, obviously we'd be looking at puts and looking at support areas. If we're bullish, we're buying calls or vertical spreads or call flies, and we're looking at the resistance areas or the target price, the price targets that the analysts are raising it up to. So if you're bullish on that trade, you're looking at that the price target estimates that the analysts are given. If you're looking at puts, you're looking at the price target estimates that they're given on the downgrades, and you're looking at those next support areas. So resistance areas on calls and target analyst price target areas for calls, and on downgrades, you're looking at the price targets and support areas for puts or put spreads or put flies. Okay, so McDonald's here, if you were bullish on McDonald's and you saw that positivity coming in there, you wanted to do a low risk trade. Well, guess what? I could pick up the 227, 230, which is slight out of the money. It's got resistance right at 230. It's going for $1.33 to be worth 250. That's not bad. 2.5, divide that by 1.33. That's a max net gain of 88% there. And you only need the stock about $1.80 higher from where it's at right now. And you're going to make 88%. Now, if you wanted to do in the money, you buy the 225, 227.50. It's going for $1.38 to be worth 250. 2.5, divide that by 1.38. That's an 81% gain. So a little bit less. But guess what? The stock could drop a little bit. Now, if you want a really low risk trade, you buy the 225, you sell the you buy the 225, sell the 220, you buy the 222.50 and sell the 225. Guess what? That's right where your support number one is at 225. So even if it drops to 225, that's your sell area. Guess what? It's still above both strikes. So you're going to have minimal loss. It's going for $1.60 to be worth 250. 2.5, divide that by 1.6. That's a max net gain of 56.25%. So that's not a bad setup, team. And that's what you got to be looking for. So if you're looking for that in the money vertical spread, make sure it's below that support area. That way, if it does hit your stop, and remember what we went over today with that lesson. If you bring up your alert and you make this trade on McDonald's right now, you could say, hey, I want to put in an alert on MCD for it to notify me when the stock gets above 230, because that's a break above that resistance area. And I want it to let me know if it gets down to 225.00, because if it drops down to 225, that's where I'm going to sell it. And guess what? This spread still has max value even at 225. So the loss there is going to be minimal. It might be worth $1.50. So you might take a 10-cent loss there, or a $10 loss per contract there, with doing that in the money vertical spread compared to the out of money. Because out of the money, if she drops down to 225, you're going to be losing 50% or more. In the money here, it's still above max net gain, so your loss is going to be very minimal. You still have a ton of intrinsic value, but your time value is decaying there a little bit. So now if you just hit OK, now that's going to alert you here if McDonald's is above 230, because if it's above 230, you could sell this for a small gain, or you could hold on to it, whatever it is you want to do. And if it gets below 225, you could sell it. So I hope tonight's class helped you guys. I hope everyone enjoyed it. Let me know in the trade room if you guys enjoyed the class tonight. Hope everyone has a great night. If anyone has any questions, you could email us at support@breakingchartalerts.com, or you could shoot me a message in the trade room or on Facebook or whatever you'd like. Alrighty, guys, have a great night. God bless and take care and stay safe out there.